Hello. Someone once told me a way to make a small fortune in the stock market. Start with a large one. Today is not a class about chasing returns. It's a class about avoiding preventable losses. Because most financial damage does not begin with ignorance. It begins with trust. The good news is that protection does not require genius. It requires a process. So be skeptical. If your investment passes scrutiny, you are much more likely to be successful. My name is Edward Brady. The best protection is education. As Benjamin Franklin said, an ounce of prevention is worth a pound of cure. You do not need perfect foresight. You just need a few hard questions asked consistently. You need independent verification. And you need the discipline to treat confusion as a warning sign, not as proof that the other person is smarter than you. The principle holds whether an asset is a brokerage account, a private fund, or a rental property. Ronald Reagan wisely advised, trust but verify. In finance, conduct background checks through investor.gov, IAPD, and BrokerCheck. Written disclosures can be found on Form ADV or Form CRS. With realtors, require either a buyer's agreement or a seller's agreement. The California Department of Real Estate provides license lookup and consumer complaint resources. So there's a variety of websites to access information. So ask yourself, is loyalty legally required or an option? Who regulates them? What fees do they get? And does that create a conflict of interest? In real estate, that means asking, who do you legally represent? Buyer, seller, both sides, or neither? What exactly do you do for me? What written agreement governs our relationship? What services are included in the agreement? What am I paying for? And how? And how do I exit the agreement if I need to? Then, verify the information you receive independently. A warm referral from a friend is not due diligence. It is only an introduction. The two are not the same thing. Compensation should be clearly defined and negotiable. People do not merely do what they say. People generally do what they're paid for. So ask the uncomfortable question first. How do you get paid? In finance, that means understanding commissions, advisory fees, performance fees, revenue sharing, referral agreements, etc. The same investment product can generate very different compensations depending on the version that gets sold to you. In real estate, it means asking what services are included in the compensation and what is not included. Is this a flat fee, hourly, or percentage-based fee? And is it negotiable? Are you steering me toward a specific lender, title company, escrow provider, attorney, home inspector, contractor, etc., because they are just in my best interest, or do you benefit from that? The recommendation comes wrapped in urgency, but with no economic clarity. That is not a minor missing detail. Pay attention to it. It's a red flag. Deed formally transfers real property ownership. Title searches look up mortgages, liens, judgments, unpaid taxes, deed restrictions, easements, and other issues affecting clear ownership. Owner's title insurance protects the owner's interest. Title fraud remains an active threat, including forged deeds filed directly with local recorder's office. California Department of Real Estate points consumers to county records and alert systems where available. If you remember only one section from today, make it this one. In finance, the most important question is not what is the return, it is who holds the money. The advisor and the custodian are not necessarily the same entity. In probably shouldn't be. That's actually how Bernard Madoff operated for decades. In real estate, the parallel questions are: who controls the title? Who holds escrow's funds? Direct real estate ownership is powerful, partly because it gives you more observable, verifiable proof. You can verify the deed, you can verify ownership with the county recorder's office. You can verify tax records, insurance, possession, HOA documents, but do not oversimplify it. Having the keys is not the same as having clean title. In securities, never confuse the advisor with the custodian. In real estate, never confuse possession with clear title. And during any transaction, never casually wire money to anyone. Use independent escrow and title procedures. Read the independent title documents yourself. Understand the owner's title, insurance. Real estate due diligence extends well beyond checking agents' credentials. Due diligence is designed to cover physical damage, discrepancies, owner disputes, and the state of rules of disclosure and contingencies vary significantly. Inspection contingencies allow the buyer to walk away from a contract without penalty if a major defect. Homeowners insurance and availability in HOA document reviews are critical. Insurance may not be available. For land, the emphasis is on zoning setbacks, utility access, easements, environmental conditions, flood and hazard exposure, and soil or septic suitability. Emphasize preliminary title review as a contingency. Checking out the person is not enough. You must also check out the thing. In finance, that means asking, how does investment actually work? How do I lose money? How is it valued? How liquid is it? And not the best case in a pitch deck. In real estate, that means asking, what does the independent inspection say? Not the seller's disclosure alone, but what your hired inspector found. What does the title report say about liens, encroachments, taxes, easements, and deed restrictions? What does the survey say? Were improvements and additions properly permitted? Does the current zoning allow the use I actually intend? Is the property in a flood zone, fire hazard area, or other designated risk zone? Can I obtain property insurance at a reasonable cost? What are the housing administration CC&Rs or the restrictions that I can live with? And are there pending special assessments? If it is vacant land, where exactly are the setbacks? And is there utility access? Or will I need to bring it in? What are the access rights to the parcel? Can the soil support a septic tank if needed? Is the land actually buildable for my intended use? Then put your answers together or get the contingency. That is a risk control built into the paperwork. So use it. If you get anything that's suspicious, call a trusted number. Persons using pre-verified contact information never really rely on instructions received by email and never using phone numbers or links supplied in suspicious messages. County recorder alert resources are available. Closing is where otherwise careful, diligent people get rushed and where real damage can be done. Everybody is busy. The dollar amounts are large, the paperwork is dense, and the emotions are high. And that is exactly why scammers target the moment. So here's the rule, stated without softening. A last-minute change in instructions is not a small inconvenience. Treat it as an attempted theft until it has been verified through a channel that you trust and you initiated. Never wire money based solely on an email, no matter how professional the email looks, no matter how familiar the name in the form field is. Look at the email that's attached to that. Never use a phone number provided in a suspicious email to verify an email. Never click a link just because the logo looks right. Before you ever reach closing day, do this. Decide exactly who your trusted contacts are: your agent, your title officer, your attorney. Write down their real phone numbers from a source that you can verify. And then if anything changes at the last minute, stop. Make a call. Slow down. A legitimate transaction will survive the scrutiny. A fraud cannot survive it. In mortgage transactions, compare the loan terms against the original loan estimate. Compare the cash to close figure. Compare every fee line by line. If something moved, a number changed, a fee appeared, or term shifted, that's why. Vacant land are favored targets because no one is present to notice unusual activity. Common warning signs for sellers impersonation fraud include below market pricing and no credible explanation, pressure for a fast all-cash sale, and insistence on using a remote notary, waiving inspection contingency without a clear reason. So let's make the red flags concrete. Observable patterns that appear again and again in fraudulent transactions. Guaranteed returns. Saw it over and over again. No independent custody of assets. An unregistered seller or an unlicensed professional. Pressure to act now, this weekend, today, before anyone else gets the deal. Anger, dismissal, or overly friendliness. Conversation that nobody in the deal can explain clearly and simple. Last minute changes in wire instructions. Records that exist only internally and only the other person can produce them. Independent verification is impossible. Property records that do not match what you were told. Missing permits. Waved away. Oh, that's fine. That's how we do work around here. HOA documents that are withheld, delayed, or minimized. Property insurance that is suddenly unavailable, extraordinarily expensive, revealed only after you are already committed. The seller of vacant land who wants an all-cash deal closed fast, exclusively by text and emails, and refuses phones or video calls, and out of the area notary of their choosing. A transaction that becomes less clear, not more, the more questions you ask. And here's one of the that connects all of them. Any deal that makes you feel foolish for asking normal questions is a dangerous deal. A legitimate transaction does not require your silence. A legitimate professional does not punish your curiosity. If someone makes you feel that asking a question was stupid, that's a warning sign. Here's some lessons from the Madoff fraud and why it still applies even to real estate. The SEC Office of Inspector General reported Bernie Madoff's Ponzi scheme. And the enduring lesson is not merely the large scale, it is the prestige, the apparent consistency, the social proof, the trusted networks, and the sheer volume of the impressive looking paperwork can completely suppress independent verification. Real estate fraud operates through the same psychological mechanism. Transaction can appear polished, fully documented, and procedurally familiar while still concealing fabricated ownership, fraudulent wire instructions, or serious unresolved title defects. So we keep the Madoff lesson in the room. Not because securities fraud and real estate fraud are identical in structure, but because the human mistake is identical. People seek confidence. They see an established reputation. They see other people, respected people, participating without apparent concern. They see thick papers, folders, and they stop insisting on independent proof. They do not stop because they are unintelligent. They stop because the social and psychological pressure to stop is overwhelming. Asking more questions feels rude, starting to feel like you're the problem. In finance, the dynamic can sustain a Ponzi scheme for years, like Bernie Madoff. In real estate, it can sustain seller impersonation, deed theft, fraudulent wire redirection, or a property transaction where the asset is far less usable, desirable, or marketable than it appeared on the day you fell in love with it. This is the checklist I want you to carry out of this class. Before you hire anyone, ask, who exactly is this person and what independent regulator or licensing body can verify their credentials or standing or disciplinary history? Who does the person legally represent in this transaction? What written agreement governs the relationship, and what are my rights if I need to exit? How does every person in this transaction get paid? And does their compensation change depending on the choices that they make? Are any referrals or affiliated business relationships shaping the recommendations that I'm receiving? Who has custody of the assets? And is it a party completely independent from my advisor? In real estate, who controls the title, escrow funds, and who files the deed? What independent records can I compare directly against the story that I'm being told? What does the inspection, title search, survey, insurance review, zoning, HOA review actually say? What contingencies or exit rights protect me if I discover something is materially different from what I expected? What changes to my thinking or my opinion or risk? Do I have time to make a decision? If I had to explain this transaction clearly to a smart, trusted friend, could I? That's a big one. A legitimate opportunity can survive scrutiny. That is really important. A bad one usually cannot. You do not need to eliminate all risk. That is not a realistic goal, and it will paralyze you. What you need to eliminate is hidden uncertainty or asymmetric risk. You need to become disciplined at verification, not as an insult to the people you work with, but as a standard practice. The principle does not change. Trust is not control. Independence verification is. When something feels wrong, when the questions multiply instead of resolving, when the urgency is disconnected from a real deadline, when clarity keeps getting promised but is never delivered, walk away.